So I think you got tired by now of investing your money into your 401k. With limited returns, limited options, no idea how your fund manager actually came to the conclusion to buy what they buy. I mean, look at some of the funds that you're forced to buy in your 401k. They're absolutely atrocious. You've been probably stumbling upon the internet looking for a way to build your own portfolio, to manage your own stocks, to get into something a little bit riskier, higher chance of return, because ultimately you don't want to be stuck in the rat race for the next 40 years. And I think if you're in that camp, you're much like myself. Of course, I invest into my 401k and a self-managed Roth IRA because you can have outsized returns with tax benefits, 401k tax deferment treatment with your Roth IRA, no taxes when you get distributions or income coming from that portfolio. You probably want to do something a little bit different, right? And in this video, that's what I want to talk to you about, how to create a portfolio to the long run. Now, creating a portfolio is an essential step for anyone looking to build their financial future. I think whether you're a beginner or an experienced investor, it's important to develop a strategy that's going to help you achieve your long-term goals. What if you need income in retirement? Probably investing into growth stocks isn't going to be the way to get there. What if you don't have a lot of capital and you're going to need outsized returns to meet your investment horizon objectives? Probably investing into low growth dividend stocks or bonds won't do that. And in this video, I'm going to provide you some practical tips about how to create a portfolio for the long run. I want to cover things like setting up your investment objectives to selecting the right mix of assets for your portfolio. And of course, be sure to like, subscribe, and comment down below if you have any suggestions or things we didn't cover upon this video. So let's get started. Now, step number one, you need to define your investment objectives. And before you start investing, it's important to do this. It is extremely important to do this. The reason why is by defining your objectives, this is going to help you determine what you want to achieve with your investments and how much risk you're willing to take on. Your investment should be smart. And what I mean by that is specific, measurable, achievable, relevant, and time-bound. When we say specific, you shouldn't say, I want to get rich from my investments. You should say something more numerical, quantifiable, something that you can actually measure over time. An example could be, I want to achieve a 10% compound annual rate of return on a yearly basis. That's very specific rather than I want to make money in the stock market. The next part of SMART is measurable. Now, you need to be able to measure how closely you are to getting and achieving your goal. Going back to the 10% compound annual rate of return at the end of your first year of investing, if you did 9% or 7% or 12%, you can measure that against your target growth rate. It's measurable. You can quantify it. Now, the third step of SMART is making sure whatever you're trying to achieve is achievable. A lot of people, when they get involved into the stock market, have outlandish ideas about how quickly a single holding in their portfolio is going to make them. I can look back to the 2021 period with the meme stock mania, where people would buy a single share of GameStop thinking it was going to get them a $5 million payout in 2 months. That's most likely unachievable. Now, of course, things can happen in rapid succession within the world and the stock market, but I think ensuring that whatever you choose to do is going to be achievable is much more grounding and important than having outsized goals, which most likely aren't going to happen. Now, with the R of SMART, you need to make sure your objective is relevant, meaning relevant to your own life, relevant to others, because ultimately all a stock's price movement or bond or any other asset class for that matter is just a change of how much someone else is willing to pay you for what you hold. Now, I think people have a, generally speaking, invested interest into the US stock market as it is one of the most investable, one of the highest rates of growth, one of the most stable, fair markets that are in the world. It's relevant to many people, and investing in the US is one way to ensure that your holdings are relevant enough to someone else to sell them to in the future. Whereas if you're looking into, say, penny stocks from a small island in the Caribbean that's only traded on a OTC market in Taiwan, not really relevant to a lot of people. Now, the third one is time bound. There are some things that you can buy, such as gold, which are always going to have a marketable value. But at the end of the day, we're not going to live for thousands of years. So you need to ensure that you have investments which are time bound, that will have a rate of return that is going to meet a set objective in a period of time prior to, well, your own expiration date. Now, once you've determined your investment objective, step number 2 is to determine your risk tolerance. Now, what do I mean by risk tolerance? I mean is that the amount of risk that you're willing to take on to achieve an investment objective. Now, risk tolerance is going to depend on many factors such as your age, income, financial goals, and personal preferences. I can imagine if you're younger with a longer investment horizon, you can afford to take on more risk than an older investor who is closer to retire. There's also personal measures to risk tolerances as well. You can imagine that during a crash, you're going to have a variety of outcomes for a portfolio that drop by 30%. And let me kind of give you a few examples for this. You have $10,000, there's news of a recession, the stock market begins to crash, and now your portfolio of $10,000 drops by 30%. You just went to a $10,000 portfolio mark. Investor number 1 is the risk-averse investor. The moment that they start to see the portfolio declining, they begin to sell out of assets. And this is good and bad depending on how you look at it, because of course the goal of investing is not to lose money, but you do need to hold things and not sell them at a loss to ensure that you have a positive rate of return. So investor number 1 at the end of the crash is down by 30%, locked in those losses, and now only has $7,000 of cash. Seems like a unoptimal outcome for myself. Now, investor number 2, the portfolio starts at $10,000 and it drops down to $7,000. They see the decline. They're a little bit upset by it, but they see this as an opportunity to buy more of the assets. So they double down, put another $3,000 into the portfolio, and now they have $10,000 at a lower cost basis. Over time, what's going to happen to investor number 1 and investor number 2? Well, investor number 1 is going to be risk averse. They're going to stay onto the sideline, and eventually the stock market will begin to rebound. Eventually, it'll go above and beyond where their original cost basis was, where they bought in when they had $10,000 of assets, and then they will purchase the same amount again. And maybe the stock market will go above that $10,000 mark, meaning, positive rate of return, and that investor will make some money over the long term. Investor number 2, who had doubled down after the market had crashed, is going to gain not only the upside from above $10,000 if we're using that as our baseline, but they're also going to be getting that spread from when they bought in at the lower cost basis. Investor number 2 is going to come out with a larger portfolio balance after all the growth is accounted for than investor 1. Now, another way to benefit from understanding your risk tolerance is really to understand at what point, at what threshold are you going to sell out? Are you going to get nervous? Are you going to get paper hands? And the way to do that is to really decide, can you stomach volatility? Can you rationalize, comprehend, understand that any declines in the stock market, provided that you're investing into a broad, diversified index fund rather than an individual holding, because companies can go bankrupt or just stop making money, is something that you're able to handle. And if you're not the type that can handle specific risks like that, you should try to sway from assets that are diversified away from single stock holdings. Now, for people who can stomach that risk, are okay with that volatility, you may be able to get into riskier sectors, ones that are more concentrated but have the concentration and ability to give you outsized returns. So we kind of went over steps number 1 in defining your investment objectives, and step number 2, determining your risk tolerances. Step number 3 is to choose your asset allocation. Now, asset allocation refers to a mix of assets such as stocks, bonds, and cash in your portfolio, and your asset allocation should be based on your investment objectives and risk tolerances. Let's go back to investors number 1 and 2 from our previous step, meaning risk tolerant Terry and risk averse Allison, just to give them names. Now, risk-averse Allison is not very fond of volatility. She sees her portfolio go down by 30%. She gets very nervous, tries to sell, calls her boyfriend or her husband or her mother and says, "Oh, I'm a bad stock investor. I just want to sell. The stock market's rigged. This is all bad news." One way for risk-averse Allison to continue to stay invested is to try to put her money into less volatile assets. An example could be she could have 60% of her portfolio into stocks for that growth and long-term capital appreciation, the remaining 40% between a mix of cash and bonds. The reason why you may want to consider cash and bonds within your portfolio is that cash has a set value, which you can get a rate of return through a money market fund. Never going to be as much as bonds or the stock market, but you know for a fact what you put in is going to be its value over time, plus interest if you're able to collect that. The bond, on the other hand, while it can have a rate of return that's positive, it's never going to be 7 to 10%. You'll be looking at rates of return of, say, 3 to 5% on an annual basis, in addition and accounting for the yield from the bonds. Just a brief aside as to what a bond is, because not everyone knows, and it's not really like really talked about in the average economy. A bond is a debt security that is issued by a government, a corporation, a business with a promised rate of return in the form of coupons, in addition to full repayment of principal or whatever you lent to them. You can think of it as you give your buddy $10, they'll give you back $1 a week until they give you back your $10. So you have return your principal plus a interest. Risk averse Allison may want to consider less stocks, more bonds as a way to mitigate volatility, whereas risk tolerant Terry may want to consider more of a portfolio of like 80% stocks, 10% bonds for some income, 5% cash, and 5% alternatives like some cryptocurrency, like some real estate, like some private equity if they can get their hands on it, some real estate notes. Something I want to do with this channel is actually to break down some alternative asset classes which you can get some good rates of return from. But in short, because he is willing to stomach the volatility of the stock market, he is able to not sell when the stock market goes down. Risk-tolerant Harry should begin to put more of the portfolio towards assets which are going to have a higher rate of return but have the chance to go down and up in a larger degree or magnitude than whatever risk-averse Allison's going to put her money into. Both strategies are right. Both strategies can get you to your ultimate outcome, but depending upon your goal, how long you have for your time horizon, and how much volatility you're willing to be comfortable with the stomach, in short, can have a big outcome and big determining factor as to what you should put your money into in the stock market. So step number 4. Once you have decided what kind of asset allocation that you want to get yourself into in relation to your risk tolerances, you need to diversify your portfolio within those asset allocations. Diversification is one of the most important principles of investing, and it involves spreading your assets across many different asset classes, sectors, and geographic region. Diversification helps you reduce the risk of your portfolio by minimizing the impact of any one investment on your overall portfolio. For example, if you have a diversified portfolio and one of your investments performs poorly, the impact on your overall portfolio is going to be less severe. And let's break down one way to approach diversification. Going to risk-tolerant Timothy, Tom, or whatever I said his name was. Tom is a big fan of equities. He wants to have a high rate of return, but he doesn't know what to put his money into. And Tom has a few options here. So let's say he has $1,000 to put into the stock market for his equities. One option for him is to buy a single stock. And let's say he decides to buy Apple. Well, Apple sells some iPhones and has a few good quarters of returns, and Tom, Timothy, whatever, is making a lot of money. And then one day there is a crisis in a warehouse. A lady got crushed by a box somewhere in the Middle East, India, United States, wherever. Bad news event. And the stock price for Apple drops by 10%. Well, so does the value of Tom's portfolio. Other way for Tom to approach this is, rather than buying only shares of Apple, he buys something known as a ETF, an exchange traded fund, which contains some Apple. But what else does the ETF have? It has shares of Nvidia and shares of Ford and shares of Citibank and shares of Caterpillar. Companies that are in different parts of the economy, which are going to give him exposure to when some parts do good, so does those parts in his portfolio. When other parts of the economy do poorly, those parts of the portfolio do bad. But on average, not every part of the portfolio is going to be performing poorly at any given time, and overall, there will be a higher or a less volatile rate of return than if he just had a single stock holding. In short, you never want to put all your eggs into one basket. That egg may have gone rotten. You want to have a wide variety of eggs, and if only a few of them do very well, of course, a few of them will do poorly, but on the average, on the net, you're going to get a higher or less volatile rate of return than if you pick either one really good stock or unfortunately one really bad stock. I'd rather have less return, but a more high degree chance of certainty of getting that return than just having that single stock. And the same can apply for risk averse Allison. There are many different types of bonds and durations, and rather than just buying a single bond, say an I bond from the US Treasury, if you've heard of what those are, in short, they match the rate of inflation. Pretty interesting a few months ago, but now as inflation's beginning to turn back down, probably not. But for Allison, if she wants to minimize volatility within a bond portfolio or that section of her portfolio, she should buy some corporate bonds and some treasuries and some municipal bonds, as well as some high risk bonds, as well as some mortgage backed securities. And the net combination between all those is going to give her a average rate of return for all the bonds that she's purchased and less volatility from any given sector about who's issuing that debt. Now, the final step, once you've created your portfolio, and this is when you may want to begin to talk to a investment advisor, someone to help you better understand your goals and objectives within the stock market, is to monitor it over time and rebalance the portfolio regularly. Now, what I mean by this is, say on a monthly or quarterly or annual basis, to review your investments to ensure that they're aligned with your investment objectives and risk tolerances. If a given part of your portfolio has underperformed, if you found something that might be more suited towards your investment return, say you want something a little bit high growth, a little bit riskier, and you review the parts of your portfolio which are underperforming or performing well but not to the degree that you want them to, you may want to consider selling out of that part and purchasing into something a little bit more suited towards your investment goals. And I'll give you an example here. I had in my portfolio shares of VOO. It is a S&P 500 growth ETF, and it was underperforming relative to another ETF that I wanted to get into, VUG. I sold my shares of VOO, bought shares of VUG with those proceeds, and now I have a higher rate of return than I did before, one that aligns more closely to my objectives. Another example could be over time, people need less growth and they need more income. And one thing a lot of investment advisors recommend is that as you get older, to reallocate a larger and larger portion of your portfolio into bonds rather than stocks. As you approach retirement, you no longer need or have time for that growth in the portfolio, which takes a very long time, but you need more income. And by shifting your investments over to things like bonds or dividend stocks, you will be able to achieve that goal. The point of step 5 is to monitor and rebalance your portfolio, because over time your goals in the market are going to change, and the things you need to invest your money into to achieve said goals are going to change as well. My personal belief, though, is that most people in their earlier stages of their investing career need a higher rate of return, and the way to achieve that is by investing into the stock market rather than something safe like a savings account. Not to say that there isn't a role for it, but you certainly don't need all your money into a savings account. If your investments have drifted too far from your target asset allocation, you need to rebalance your portfolio by buying or selling assets. In short, it helps you ensure that your portfolio remains aligned with your objectives and risk tolerances over time. So in conclusion, creating a portfolio for the long run involves careful planning and a disciplined approach to investing. You need to define your investment objectives, determine your risk tolerances, choose the right mix of assets, diversify your portfolio, and monitor and rebalance regularly. And doing this will help you create a portfolio that will achieve your long-term financial goals. Now, of course, as I recommend in all my videos, remember to consult with a financial advisor or professional for more personalized guidance and advice. This video is solely for the purpose of giving you generalized knowledge as the best approach to this topic. The one thing I will recommend for you today is to check out our link in the comment section and description of this video below for Webull. Webull is a great investment platform with a wide variety of assets that you can get into, not only the stocks, bonds, cash securities, as well as cryptocurrency securities that we have talked about before, but things like real estate investment trusts, as well as a variety of other options as well. By the way, if you want to get a high rate of return in your savings account, they're offering 5% right now for money market funds, which is crazy. Probably a lot better than you're getting at that regional bank in your hometown. So what I recommend is to check out the video, sign up for Webull today, get some free stocks as they're running a promotion right now for you guys that, of course, I'm going to let you know about. And let us know your thoughts about this content in the comments, and be sure to like, subscribe, and let your friends know about this video. On that note, everyone, be sure to turn those rags into riches, and let's make some money today. Talk soon.